Welcome to Simple Investing Secrets. In today's video, we'll review 7 undervalued stocks to buy and hold right now. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. The search for undervalued growth stocks is on, with the stock market seeing a nice upside so far to kick off 2023. While not much in terms of the macroeconomic environment has changed, there are reasons for improved optimism among investors. The declines seen in many sectors last year could pave the way for outsized gains over the medium to long term. That is for investors who decide that the bottom is near for companies with multiples that have contracted significantly. The list of growth stocks that have seen their valuations dip into value territory is relatively long. There are plenty of tech companies now trading in what I would view as distressed territory. However, outside of tech, there are plenty of other growth at a reasonable price options worth considering as well. Interest rates will likely continue to rise from here. No one really knows how long the Federal Reserve will keep rates at these elevated levels either. But for long-term investors seeking decent returns over a 5 or 10-year time horizon, now may be a great time to start considering beaten-down stocks. Here are 7 such growth stocks that we think are worth diving into right now. Number 7. Royal Bank of Canada, ticker, RY. In the categories of growth stocks and undervalued companies, Royal Bank of Canada is one of the most intriguing and undervalued on our list. Sure, Royal Bank isn't as exciting as many tech companies or other high-growth stocks in more attractive sectors. This Canadian bank, with operations in the US and many other nations, is about as mundane as any other financial stock in the market right now. So this well-diversified global bank is one of the best choices for investors who want to spread their money around the world. Thus, from a diversification standpoint, there's a lot to like about the value that RY stock provides. From a growth standpoint, Royal Bank is a standout in the banking sector. This lender has produced a compounded annual growth rate of 8.3% in terms of earnings per share growth over the past 20 years. Taking into account the dividend yield of the company, which is currently just under 4%, investors have a lot to gain by being patient. Number 6. Meta Platforms, ticker, META. The largest social media company in the world, Meta Platforms, has seen its reputation shift over the past year. Headed by CEO Mark Zuckerberg, this company has promised a big turn toward the metaverse. What this has meant in terms of Meta's strategic focus and significant financial investment is noteworthy. Indeed, in recent quarters, Meta's Reality Labs division has been losing billions of dollars. Accordingly, many investors may simply want to steer clear of Meta stock. Other worries about Apple's iOS data sharing policies haven't helped, and this puts the company's plans for making money in danger. That said, the recent impressive decline seen in Meta stock provides investors with a great opportunity to pick up one of the best growth stocks at an incredible valuation. Currently, Meta stock trades at around 13 times trailing earnings. For a growth stock that has shown consistent bottom-line growth in recent years, this is an incredible valuation worth considering. Although headwinds do remain, we think now is the time to start considering backing up the truck on Meta stock here. Number 5. Star Bulk Carriers, ticker, SBLK. Another less conventional company to make this list of undervalued growth stocks is Star Bulk Carriers. Based in Greece, Star Bulk is one of the global shipping operators that has been thrown into the spotlight of late. As shipping costs have risen, so has the company's top-line growth profile. Indeed, with a fleet of 128 dry bulk carriers with a carrying capacity ranging from 52,247 to 209,537 deadweight tonnage, the company is one of the leaders in its oft-forgotten sector. Star Bulk will still be needed for global supply chains so that bulk goods can be shipped around the world. Thus, the company has a defensive profile worth considering on this basis. However, a number of analysts have pointed out that Star Bulk's net income growth of 79% over the past 5 years is remarkable, as is its return on equity metric. For those looking for a bottom-line grower, this company also fits the bill. Trading at around 2.4 times trailing earnings, there are few growth stocks with this kind of a multiple trading at depressed levels right now. In our view, this is certainly one of today's better undervalued growth stocks. Number 4. Advanced Micro Devices, ticker, AMD. Along with numerous other growth stocks, Advanced Micro Devices was hit hard in 2022 by reduced spending on technology and rises in inflation. However, the dismal year hasn't hampered its stellar long-term prospects. Even with last year's sell-off, AMD's shares have increased 493% over the previous 5 years and almost 3,000% in the last decade. The semiconductor company's sales have grown by 153% since 2018 and will reach $16.4 billion in 2022, while its operating income has grown by 1,000% to $2.6 billion. As a result, now is an excellent time to invest in this undervalued growth stock, with its price still down 36% year over year. Even though AMD's PC-focused client segment lost money in the third quarter of 2022, its data centers segment did not disappoint. The company's data center business saw revenue increase 45% year over year to $1.6 billion, with operating income rising 64% to $505 million. And the company has plans to expand further in this booming market. In November, AMD launched a new generation of data center chips named Genoa and plans to release a more powerful version called Genoa X later this year. Companies like Alphabet's Google, Microsoft's Azure, and Oracle are already using AMD's services, so the company is in a good position to keep making money as the market grows. The company's forward price-to-earnings ratio of 20.7 is especially attractive considering its prospects. The same metric for its biggest competitor Nvidia is 57.6. The stock of Advanced Micro Devices took a beating in 2022, but given how well it has done over the long term, it is unlikely to stay down forever. The company's shares have risen 16% since January 1, 2023 as investors reevaluate AMD's potential. As a result, now could be the perfect time to invest in this exceptional growth stock. Number 3. Apple, ticker, AAPL. Apple is a solid growth stock in all aspects. Over the last 5 years, the company's shares have soared by 211% and by 664% in the last decade. Revenue has risen by 48% since 2018 to $394.3 billion in 2022 and operating income has increased by over 80% to $119.4 billion in the same period. That is mostly because its products are in high demand and because it is good at getting into new markets. Counterpoint Research says that when Apple's iPhone reaches 50% of the smartphone market in 2022, it will officially pass Alphabet's Android. This is especially good because of the company's walled garden of products. When people buy one thing from the company, it often makes them want to try out more of its devices and services. And 2023 holds a lot of promise for the tech giant. In the first 20 days of the year, Apple announced more powerful chips for MacBook Pros, a stronger Mac Mini, and a new HomePod. Reports say that the company will soon start selling a new headset for augmented and virtual reality. It is also working to make its iPhones less reliant on parts made by other companies by making more of them itself. Each of these things has the potential to bring in a lot more money in the long run, which makes Apple stock a great buy in 2023. Number 2. Alibaba, ticker, BABA. Alibaba Group is one of the world's leading e-commerce and cloud service providers. The upward trajectory in these markets should set up Alibaba for tremendous growth over the long term. However, the company does most of its business in China, which has faced unprecedented economic headwinds lately. The stock is trading about 65% below its all-time high because people aren't spending as much money as they used to. There are still problems with the pandemic and inflation, and there are regulatory clouds over big tech platforms. At these lows, investors can buy one of the top tech companies in the world for an incredible bargain of 14.5 times 2023 earnings estimates. When the company was growing faster before the pandemic, the stock traded at a valuation of over 30 times earnings. Over the last few quarters, revenue has started to stabilize. In the third quarter of 2022, Alibaba's revenue went up by 3%, which was better than the 1% drop in the previous quarter. Another good thing for the company is that regulators seem to be paying less attention to it now that Alibaba has signed a cooperation agreement with the government of Hangzhou. With growth improving and the uncertainty of regulation starting to clear a bit, the stock has shot up 28% since the start of 2023, but it's still a bargain. China's economy won't stay down forever. Consumer spending will pick up eventually, which should drive faster growth for Alibaba. The upside from these lows should lay the foundation for above-average returns for years. Number 7. Lowe's, ticker, LOW. Shares of Lowe's have outperformed Home Depot over the last 10 years, and management's strategy to further improve financial results could deliver even better returns from here. In 2018, Marvin Ellison became CEO of Lowe's. He put in place a plan to modernize the company, including a stronger supply chain and a better shopping experience. Over the last 4 years, Ellison has led the company to slightly faster quarterly revenue growth than Home Depot. Also, the company's adjusted operating margin has closed the gap with its competitor by a large amount, but management thinks there is still room to increase profits. Lowe's increased its adjusted operating margin by more than 4 percentage points between 2018 and 2022, bringing it to 13%. The goal of management is to get the operating margin up to 14.5%, which could be done through disciplined cost management and better pricing of products. Investing in stocks that are growing profits faster than revenue, thanks to expanding margins, is a recipe for market-beating returns. What's more, Lowe's is benefiting from long-term trends in home price appreciation and ownership that favor growing home spending over time. The company is executing against its goals, and with the stock trading at a relative bargain of 15.2 times this year's earnings estimate, a discount to Home Depot's 19.8 times earnings, it is a solid investment that should outperform its rival in the broader market. This concludes our list of 7 undervalued stocks to buy and hold right now. As always, it is essential to do your due diligence before committing your hard-earned cash to buying stocks or investing in the market. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching, and best of luck with your investments.